Welcome to episode 3 of the Philly Multifamily Podcast. I'm here with Matthew Rosenberg, the head of Scope Capital Group. Welcome.
Thanks, Tom.
I'm glad you're here.
It's good to be here.
We have a lot of requests for financing people to come on. Just given the state of the market, it's a very confusing time, so that's why I wanted to have you on. So thank you for your time. I know you're very busy.
Well, it's an honor to be your first finance guest, and I apologize. This is the first podcast I think I've ever been a part of. So
First, not the last, Matt.
first, not the last.
You have to come on whenever I ask.
I'll try my best here. I'm no DJ, but I am a finance guy.
So could you tell the audience a little bit about yourself?
Sure. So I am in the commercial real estate
Speak of the mic, Matthew.
lending sector. I've been in this sector for a little over 15 years. It's kind of a weird how I got started, but I've been through a lot of jacks of the trades out there before I got into commercial real estate. I responded.
This is your first job out of college,
This
right?
is my first job out of college. I got into commercial real estate finance in the capital markets of CBRE. It was an interesting journey how I got there. I never intended to be in commercial real estate finance. During my days at Temple University, I responded to a Craigslist ad that said real estate interested or real estate minded person in Philadelphia looking for an analyst position. So I responded to it, put on a suit. It ended up being CBRE Capital Markets, which is the largest commercial real estate company in the world. I did not know that at the time. I walked in, I think I said 3 words. I got hired. It was an incredible experience. That was circa 2005. And it was a great run till 2008 when I experienced the Lehman crash and the whole market's going under. But before that, I got to witness my superiors making a lot of money. From there, I ended up going up the ladder. I worked at Marcus & Millichap for 8 years. Prior to Scope, I ended up pretty much overseeing their debt division out of Philadelphia in the downtown office. I think I must have been a part of hundreds of transactions with Marcus & Millichap, and it was also a great experience living, more in the middle markets from the $2 to $20 million range to where CBRE I was working on your, $50 million and up deals.
Right.
So I've been doing this now for, over 15 years. I've seen the ups, I've seen the downs. Last year was, not 2008, but it was one of my trickiest years in the business so far. And tell me if I'm getting a little off topic
No,
here.
you're doing great.
Just trying to roll with it. So
what do you do now on a day-to-day basis, right? You're in capital markets. You're not a lender.
Correct.
You're a broker.
So one of the major reasons that I was swayed to grow with Scope is Scope is made up with some of the best investment sales agents in Philadelphia, in my opinion. On my side, the capital markets, it correlates very well with agents going out to the market trying to sell properties to where they need to understand what the underwriting looks like on an everyday basis of how to go out and pitch those sellers to where those sellers might be like, now's not the time to sell. I would like to refinance. And then my side of the company, it comes in and it's a nice correlation to offer a full service suite of products with Scope.
Sure.
So I've worked very closely with Scope's team. I want to say over a handful of years right now. They've been my top referral for new loan requests in the market. So my day starts with coming into the Scope offices, saying hello to each one of the agents, putting the Scope Capital Group brand in front of them at all times, trying to make myself or my team always available to help with the agents on their pipeline of business if they're going out looking for new listings or if they just need me to come into a client meeting. We always make ourselves available. We're a service to the investment sales side.
Right. We get in front of a lot of clients first, right? And we always want to show them what their exit will look like on a sale or refinance, right? And if we can capture one of those two businesses, it's a win for everyone, right?
Correct.
And 4 times out of 5, they will refinance typically, right?
That has been the experience for the past, bull run of the decade. I think, over the past 6 months, we've definitely seen a shift into the recapitalization of, especially multifamily products or projects in new construction. Does it make sense to refinance still?
Sure.
The market undertook 8 rate increases last year going into this year. It was tough to grasp what was going on from either side. So there's been a lot of players just on the sideline as to, their performance were completely thrown off to when they underwrote the deal 18 months to 24 months ago to now on their exit strategies. The rates have doubled, cap rates have increased. Their cash out scenarios that they initially intended are off the table. Or, unless you went in super conservative, you might be considering a sale right now, or you're looking at a whole other investment strategy of that asset.
I feel like the capital markets vary week to week. It changes so quickly with rate hikes happening every month, almost for the last 6 months or so, right?
Correct.
And then the 10-year treasury kind of seesaws between 3.5 and 4. So depending on the week, like we have to update our debt quotes every week, right? And if we pitch something last week, this week it's totally different, right? So I think that's the value that you bring to the table as an advisor, right? And having your finger on the pulse of the capital markets, where it's a very fast-paced environment, right? So knowing where to, look and who to rely on is more valuable now than ever. Because when times were good, 18, 24 months ago, they were printing money like gangbusters. Everyone has a banking relationship that they can rely on and get super cheap money. That's not the case today. So I do want to be clear, though, you don't just do multifamily financing.
We do all the food groups.
All the product groups.
And my background, I was involved in dozens and dozens of net lease 1031 exchanges to retail shopping centers. We're bidding on office buildings, office conversions, multifamily. I'd say over the past 24 months at Scope, the Scope Capital Group has done north of $100 million in new construction ground up around the Philadelphia region alone, as well as some new construction outside of Philadelphia. But the projects have consisted to 120 units ground up at 12th and Vine Street, a 90-unit ground-up project at 1701 North 2nd Street, 84-unit ground-up project right under the L at 2nd Street. We did an adaptive reuse of the Bentley building in Rittenhouse Square, which was approximately 60 units. We did a lot of new construction when the prime rate was closer to 3.5%. And, spreads over prime ranged from, I was sitting in a meeting yesterday, the prime rate, or the spread I locked over prime 2 years ago to the date was 25 bips over prime. To now we're looking at it 2 years later, prime is at 775, potentially at 8 in the next week, and, they're paying an 8% rate. Now what we're seeing is the pro forma that was initially crafted and the interest reserves were built off those 4% rates.
Yeah.
So, in project timeline about now from 2 years ago, we're getting some calls that interest reserves have been depleted. There's capital calls going out to partners. We had a lot of calls initially on our interest reserves for projects where we wanted 2 years of IR. And sponsors would push back that it was too much and wanted 12 months of IR. Those sponsors are now finding themselves making the capital calls to their partnerships. It's interesting. No one anticipated rates to be shocked that quickly It was really okay, rates are here. Let's do a transaction. Right before that transaction is about to happen, the Fed shocked it again. Okay, let's sit back. So last year was unique in that it wasn't a 2008 occurrence of just like stop. Right. It was a shock kind of deal, and it was really annoying. My team, we have some of the best guys out there. We've spread nationwide. We're in San Diego, Colorado, Philadelphia, North Carolina, New York. We have great team spirit, great culture. We get together every other week and discuss what's going on in the markets. Everyone on our team was executing on closings last year, regardless of the market. There was a lot of retrades, but you couldn't point the finger at the broker. It was like everyone just had to roll with the punches.
You can't really fight macroeconomic forces, right? You can't blame the finger on one person for the actions of the Fed, which at that time were, not predictable, so to speak, but they gave us warnings, right, that they were going to raise rates, but it just seemed like one after another they kept coming, and we take one step forward and two steps back, right? So I hope we're, finished with rate hikes. We found some clarity in the market, but the last 2 weeks, we've seen rates jump back up again, right?
We've seen rates jump up. We've seen consumer spending, debt go through the roofs. Inflation has not really come back down that much. We're starting to hear that, liquid positions of banks are also depleting. So when we're going in with a new loan request that's out of market, or there's no heavy presence of a homegrown borrower building in their backyard, they just want to go after, let's say, a Walgreens in Tennessee. Those banks who used to do those Walgreens in Tennessee, are we having technical issues?
We're good.
They might come to me and say, but what's the deposit relationship going to look like? And now we're seeing that from 5 out of the 10 lenders that are quoting the deal say, hey, what kind of deposit can they bring to the bank? We just don't like to, be a transactional out-of-state bank, to where a few years ago it was how many can we put on the book?
Right.
So I think we're seeing the banks kind of pull back a bit right now, cherry pick the right situations. We're seeing new development being really taken conservatively. Does it pencil at these construction rates? Is the sponsorship liquid? Can they take a cushion if over 3 years of this project, to where some of the construction loans we were getting done 2 years ago, in my opinion, knowing what their liquidity was on hand to some of these private clients, I'm a little concerned going to bed for them. I can only imagine what some of these guys, the pain they're going through. But it seems like all these projects, the banks are working with them. They're stepping in. They're getting.
We saw that at the start of COVID, right, with the forbearance.
Correct. And the good news, I mean, nothing's ever good with COVID, but we plug through a different experience than I was ever used to. I mean, talking about the COVID days, I think it threw everyone off their schedule. My work balance was, waking up, walking into the office, and spending the whole day there every day was my life for a decade. Suit and tie, corporate work, and I know we're getting off topic here a bit, but
it's freestyle.
I think it's definitely that something that should be brought up on this podcast. COVID is not forgotten. I think we're just starting to read about all these office buildings,
with the zombie loans.
It's all starting to roll out. Interest reserves depleted, office vacancies. What are we about?
Something has to give, right?
Something's starting to give.
Yeah. It's exciting for young people who are looking to enter the real estate space, right? Prices have been high for a long time, and we're starting to see them come back down, but they're not to pre-COVID levels, right? So how would you coach someone who's looking to get into real estate investing?
Sure. I think, if you're new to the industry, you're not very well capitalized like some of these gajillionaire sponsors out there. I would say, look in maybe some lower income neighborhoods. It's single family rental properties, which I know you've done. I think it's not only a great way to see, how the whole process operates on a smaller scale, to take your knowledge of, how did I get through this SFR fix and flip or rent, and see all the nuances in it and feel the pain of, smaller construction issues, or little things here and there that you never knew about just trying to broker real estate. Take some of your fees that you're making on brokering deals, and maybe you can't afford the 10-unit apartment building, but go out and buy a cheap rental house and try to figure out the nuances of it, and you'll get smarter to go out on the bigger properties and be able to talk to owners, knowing I just did this, or I know how to do this, and there's more of a discussion you bring to the table.
$16,000 to turn a unit, right?
Yeah.
Swap out kitchens and baths.
So I did a little of that in North Philadelphia. I dabbled in it in an SFR portfolio with a partner. I think we got to 17 units in total or something, and then last year we sold every single one of them when COVID hit. And we made some. I think we hit it triple. Right? Yeah, we hit it triple, but I learned so much about the whole professional tenants out there. Of it can be a rough process.
The management.
I learned my evictions. I was in L&I court. Yeah. I saw some stuff that doing loans. You're just never a part of that. So being able to experience that side of the investing and putting my money to work, and then having a guy run it, and doing this, it was a fun experience. But thank God I sold it all, and I'm never looking back.
The best coaches don't play, so to speak.
It was good. We made money. I think moving forward, my money I would invest in real estate would really be main and main. High level credit checks on every tenant. I wouldn't go into as hairy neighborhoods as I was going. I experienced too many headaches. Made a lot of money, but wouldn't go back to it.
Right. It served its purpose. On to the next
one. It was cool. It was fun.
And by not doing that, there's no way you could have actually gotten that firsthand experience.
No. And I learned a ton. I want to say I've been a part of financing thousands of homes around the country, a part of larger single-family portfolios. So I became aware of what their performance looked like and what their investment strategies were. And I looked at a pocket of Philadelphia with a guy who had the crews to do the construction, and he was asset managing. And really, it was a passive position to me to be an investor, and I went for it. And it worked out well. But I learned a ton from that. I don't think it's something I would do again. And doing it, it also made me realize how much more I like the job I'm in and the role I'm in. I don't see myself more as a developer. I see myself as more of a CFO behind the scenes of these deals, or just talking about debt structures and loan structures that are going to be available to the guy that wears the hat. I love that. I think me being a developer, it's not for me at this time. It's waiting around for bricks to pile up. It's for someone else.
It's, I think we're lucky in our brokerage role in that whenever we get tired of a deal, it kind of closes and we're on to the next one, right? We have deal ADHD.
Deal ADHD. You're only as good as your next deal, I've learned in this industry.
Right. And so, getting handcuffed to a pile of bricks or, project you're trying to get off the ground, definitely takes some getting used to in our position, right? But that's why you have to be so selective on the deals that you do, right?
Correct.
So what kind of deals are you going to do in the future?
So I'm not, here to talk about deals I'm going to do. My sole focus these days is growing the Scope Capital Group team more on a national basis, to have a grasp of the entire macro market. I think it's so important to know what's going on around the country every day, and discussing live terms and pricing and structures in the market, to where I want that to be my time. I'm not worried about Matt Rosenberg investing in
Right.
development plays. If someone comes to me and says, Matt, I have this great idea, I want to develop it, maybe I'll look at,
Sure.
putting a passive position in. I think, for me now, it's focus on the finance, 100%.
On the business.
On the business.
On the business.
Yes. I'd say if I was a developer in Philadelphia, I think where this city is ahead of a lot of cities are like a Florida, where it's like 80s built stucco type of buildings all over the place. Philadelphia has some great bricks and insane old warehouses and factories and manufacturing plants that they're still not all picked up, and there's so much opportunity on value add scenarios in Philadelphia and working through variances and that type of deal. That's where the value add is that I love in Philadelphia. That if I were to be a part of a transaction, the overbuilds that you can accomplish in Philadelphia, the numbers were penciling a lot better 2 years ago than where they are today.
Sure.
But I love, the creativeness that comes along with Philadelphia and the projects you can do here compared to other cities. There's a lot of value add scenarios.
Yeah, the city is growing so quickly, and it's great to see some of those sites get reused. Even if they're not really cost effective, that's the type of product that people want to live in and will shell out a couple more dollars compared to a brand new construction unit, right? They lease up much quicker and people stay in them longer, right? I live in one myself, so I think, as someone who looks at apartments all day, every day, that speaks for itself, right? But you spoke on the market previously. We're in a weird part of the market. It's good. It's
Definitely weird. Deals are still getting done. We just put a deal under application last week. It was a Freddie Mac loan. There was more than usual interest only on the loan.
There's a special going on right now, right?
There's a special. Given my background, I'm very plugged in with the agency correspondence. We get discounts. This deal went under app with a colleague of mine, Ed Brown, who's been in the business over 40 years. He was working on the acquisition with Zeke Rotter upstairs for a building in the Northeast that just went to contract. But he was able to get high leverage. I think it was 75%, 4 years of IO on a 10-year fixed term, 30-year M, non-recourse, and the fees were very fair, I'm told, where we beat out national competitors that were up against us.
Right.
So that deal got signed up last week. We're still looking at a lot of the agency SBL product. I think we're relying more on acquisitions than refis right now. We're still selectively looking at construction. We're seeing an uptick more in off multifamily and value add construction and ground up. We're doing
like industrial or
industrial. We've been bidding on a lot of net lease. We're about to go under app on a medical office building in California. I mean, we're driving a process with new loan requests that is different than I used to do, 10 years ago. I'm trying to keep with the times with the capital side of the technology that's available. And it's insane what we have at our fingertips to go after this new business development. 15 years ago at CBRE, I was making deal libraries with physical folders in the bullpen. To where if my boss asked me about a deal, I would go out to the bullpen library, pull it off the shelf and start looking through. And now, I got my CRM, everything's at my feet. I go in, I see who owns the property, what the loans are. I zoom out, 10 miles, see every single lender in the area. That I'm like, oh, I know all those guys, and it's just. It's not for everyone to go do, but the guys that have been in the business know how to talk the talk. The software is insane.
Right. I think that's part of the reason why we're here, right? We have so much access to technology, and that's why we felt comfortable kind of branching off and creating Scope and Scope Capital Group and working.
I absolutely agree with that.
Yeah, none of this would have been possible even
No.
5 years ago, I think.
No, the technology definitely helped make the shift to, make me more comfortable that, hey, I can target this whole playing field, and I don't need Goliath behind my back.
Right.
Like, we can do this, and we have done this.
And
We've
we have
done
a track-
hundreds of millions of dollars
track
in the
record speaks
past
for
handful of
itself.
years with Scope,
Yeah.
which is incredible.
What's in the horizon for the market, right?
I'm more excited about the horizon than today. Where I see the market is today, everyone's kind of in this like woozy of like, we were at 3% rates when I put this model together, and now I'm at a 6% rate. But I like it because what I hear from the loan officers is the banks are all making money at 6% rates. They weren't really making money at 3% rates. I think what happens over the next year is that 6% rate becomes the new norm. I think sellers finally realize their property is not worth what it was last year, and reality starts to set in. Some of these sellers or owners are going to say, I'm just going to hold this for another 10 years. And from my side, from a volume perspective, it's definitely come down to when rates were at 3%. It's way more relationship selective. The transactions aren't going to be like bam, bam, bam because they don't make sense. I mean, it made sense when it was at 3% to everyone go in and get that money. I got that money. I bought a house. I got that money.
Easy.
It was amazing. Now I think it's, selectiveness on where do these rates make sense with what I can buy on this value, and over the next year I think values dip down on multifamily mixed use to where a lot of these developers are saying, what's the point of building this ground up if I can go out and buy 6.5 caps?
Right.
That's what I see. So that's why I love being a part of an investment sales group, and I'm not, Scope Capital Group's not a mortgage shop on its own, because working with you guys, we see the streets, we know what's going on. There's the deal got signed up because Zeke just put a deal under contract, and our debt team's here ready to go.
You already pre-vetted.
Ed was telling me this deal they put under application, he offered them, I think the rate was like 5.46%, 4 years IO on a 10-year term. The application went out, and our loan officer calls Ed at like 11:45 that night, and he's like, rates are going up 35 basis points tomorrow morning. Like, if your borrower's smart, like, he'll sign it. Someone pulled that move to me, I'd be like, they're trying to push me in a corner. They were like, no bullshit, your rate's going up 35 tomorrow. Like, I don't know what they did. The guy signed it 11:45 that night.
Oh,
they put the deposit in, he locked a 5.46, and I think rates the next day went up 35 basis points. And that's kind of another annoying thing with these agency products is they kind of control their cost of funds. They'll raise it, they correlate kind of the treasuries, so treasuries went up 35 basis points. Agency rates were kind of already high in my opinion, but they raised them more. So it's like right when all these people were about to transact at 5.5, boom, they're 5.75. So what does that do to the person selling it? They're going back and saying, hey man, I want a discount. And if the seller, I've witnessed a lot of guys working with you investment sales agents, they're not going to bend that easily.
Nothing material has changed to their product.
Correct.
Right?
And they think like, oh, you're trying to jab me some more. Get it? That's why I think we're really looking at like a 6 month to a year horizon of stabilizing out and transactions picking up. My busiest time ever in my career was after the collapse of 08, 09, I hopped into a boutique investment banking firm for a little, then went to Marcus. Things were coming up, but I called through that market every day during the shit turn, and it was some of the toughest years of my career getting by. But then all of a sudden, as things started stabilizing, and I was in front of those people every day as the guy that's like in front of the money, I had the best year, I think, one of the best years of my career, in like
Coming out of it.
in that 2013 to 16, just like it was just like bam, all of a sudden my pipeline was on fire. So, I would say you need to have patience. This is not your 9 to 5, normal job by any means. It's a hustle. You got to plug through the downturns, hold your reserves. That's been one of the biggest things. I've been very conservative with the fees I make. It's either going to go into an investment or it's not going to go into, a Porsche or something like that. Where I've seen some brokers get like super fat during the good times and they'll go out and blow it. And I saw it in 2008, and those brokers were, toast the next few years. So I've learned a lot of lessons.
Keep your emergency fund plump.
Correct.
Yes.
Always hold your reserves.
Who are your lenders? No, I'm kidding. How can people find you and get a hold of you?
People can find me scopecapitalgroup.com, LinkedIn. I actually share my contact info on LinkedIn. I'd say for any of the loan officers out there listening, if you click on your contact info on LinkedIn and it's not there, you're making a mistake.
Missing out on free business.
Brokers or owners are looking for a bank, like a loan officer at that bank. They come across you, they look you up, they don't find you, they go on to the next guy.
Right.
Or it's a mistake. So I do have my contact info on LinkedIn, but Matthew at scopecapitalgroup.com, you can reach me, or call Sam.
I'll get you in touch with Matt. Don't worry.
But I'd say, most importantly, my team is here to help structure deals. I think, being able to structure the right loan product for an investment strategy is even more important than the interest rate at the end of the day, where I think once my career started to move up was when I knew how to get very creative around, how the metrics of this deal are working, or what you're missing out to get to the next, leverage in your loan to cost and not loan to value, or, how to bake things in, how to look at interest only, no prepayment to exit into this. There's things, I was missed at the
yield
beginning.
maintenance.
Correct.
That's why
when we approach a deal, we've changed our method, how we, on every deal is different, but we'll show you 10 different options of how we can structure your deal and then get you most comfortable with the structure and then say, hey, we can price this like this. I never like to start a call with like, hey, what's your rate?
What's your fee? What's your rate?
Yeah, that's the worst call to take. It's really diving into the models and coming back and devising a plan and then going after it. And I'd say, we're closing 100. I want to say everything that goes under application, we're executing on because our modeling and our underwriting and our knowledge of what you guys bring to the table from comps in the area and how to look at a deal. We're sizing it to what it's going to be, to where, starting out and looking at other brokers, they'll just throw, shit at the wall and hope it sticks and come back and tell the guy it's worth, this much left. And that's not our style. We'll lose deals because it's not worth us wasting 2 months to get to $1 million less on a loan amount. Right. We like to say like, hey, look, this is where it's going to be, and we'll stand by that. When we put a deal under wrap with the lender, that deal's getting done.
Okay.
Yeah.
If you need some money with surety to close, Matthew Rosenberg.
Thank you. Thanks, Tom.
Thank you.
It was great to be here.
It was fun, right?
Yeah. I'll see you in a few years. We'll do this again.
I think I need you on like once every other month or something for a financing update.
I'm into it. Thanks, guys.